Marcia says, when looking at selling puts, so let's go back to naked puts here. We'll just go into the default search. She says, oh, it's a different question, I'm sorry. I see that the premium for selling puts with strikes higher than the stock price are much higher than the covered calls. Why would anyone sell puts with higher strikes than the stock price? Is the option not in the money now? Yes, it is. Let's go back to NVIDIA, since we've been using NVIDIA as our example today. And let's go to the chain. We're just going to go to the put chain here. And I'm going to go let's go out 14 days, since we've been talking about that for a while. Oh, no, we need to be on a call and put chain. I apologize. Fantastic. Okay, good. And I have the columns that I want. Okay, so what Marcia's asking, naturally, is when we were selling puts, where were we on the video? We were at the 300. We increased the probability to go to that 70% probability. We were up at the 310 strike, which is at 418. And Marcia, of course, saying is that these higher price strikes have the higher premium than the calls. Yeah, well, what we're comparing here is that the 345 strike for NVIDIA trading at 330, 329.85. The 345 strike is roughly 345 strike put, Marcia, is 15 points in the money. $15 of this 2110 midpoint is intrinsic value. You only have $6.10 roughly of time premium on the position, where the out of the money call that has no intrinsic value is the same price. Ask price roughly at $6.50. 2% time premium versus 2% time premium. The rest of this is intrinsic value. Okay, so you say, why would anyone sell puts with higher strikes than the stock price? Am I forced to buy the stock at the higher put strike? Yes. If I did sell this 345 put and I was assigned, or the stock stays below 345, I'd be assigned to buy it at the higher price. But what's my break even? 345 minus 2110. I take that into my pocket right now, Marcia. I have that in hand. So if I do get assigned wherever the stock is, let's say it stays right at 330, my cost basis is the 345 minus the 2110, which puts us at a cost basis at 324. I'm still 5 points, 6 points below the stock price at 330. What is that? The time value. That 650, 690 ask time value here. The bid is probably closer to $6. So that $650 of time premium lowers my cost basis if I was assigned. The remaining $15 or so here at 2110 at midpoint, that's the intrinsic value. Okay. Yes, you'd have to buy the stock at the higher price, but you are getting paid for the benefit to do that. What you want to focus on when you're selling puts is the time value. Okay. That's what you want. What is your goal for a 10, 14, 5-day out trade? 1.5%, 1.7%, the ask time value, the percent naked yield. And if you don't want to buy the stock at the higher price, Marcia, you want to buy it at a lower potential price. 315 sounds like a good price. 317 sounds like a good price. Well, you know you're getting the premium up front. In general, Marcia, I'd say, okay, I'm not going to assume, because, we know what happens when you assume something. But I'd say the larger portion of cash secured put sellers, Marcia, naked put sellers, are in this range. They're selling out of the money puts, a few percentage out of the money, looking for a time value somewhere between 2 and 1% for a weekly option or 2-week out series. Go monthly, maybe 2.5 to 3% out of the money. There are investors selling in the money puts, but they're not doing them as cash secured puts. You don't know what they're doing. That could be part of a calendar put spread. That could be part of an in the money bear put debit spread, where I'm selling a 335 and maybe buying a 345 at a debit. As long as the stock stays below here, I'm going to make a leverage profit, just as our discussion, Marcia, with the bull put credit spreads, but it's a debit spread. That's a potential. People could be doing ratio back spreads by selling in the monies and buying at or just slightly out of the monies, or reverse, selling out of the monies and buying slightly in the monies. Okay? So you don't know who is exactly selling the in the money puts. It could be someone selling an in the money naked put, saying, hey, if I get assigned NVIDIA at 345, but I take in 2110, so that puts me down at that cost basis of 324, and I'm bullish on the stock, hey, maybe that's okay. because the stocks are trading at 330, I'd still have a lower cost basis. Maybe that's okay to do it in this case. It's not the premium, the raw premium we want to look at when comparing same strikes for in the money, out of the money, calls or puts. What the focus is the time value. And they're going to be pretty close to one another as far as what is the benefit of selling an out of the money naked put versus buying the stock and selling an in the money covered call. They're parity trades of one another. They have the exact same risk reward profile. What's the risk reward and benefit of selling the out of the money covered call with a 2% time premium but chance for appreciation versus selling the in the money put where you might get assigned stock? It's going to have almost the exact same risk reward profile. Max percentage return to the upside if the stock's above 345, break even, very similar, and of course, loss if the stock falls 5 or 10%, they're going to be about identical in those cases. Okay, so Marcia, that's what the focus should be on, is the time value. Yes, these prices are much higher because we're dealing with intrinsic value on the put and just out of the money for the call. It's all extrinsic or time premium. When you compare the two time premiums for the same strikes, you're going to see about the same percentage and the same monetary time value. And yes, in general, for naked put sellers, we're down in this range out of the money, as you mentioned, looking for the return that meets our goals for our time frame that we're comfortable with, whether you want to do weekly, 2 weeks out, or monthly. That's what you're going to look for. That's what you're focused on, should be the time value and the percentage naked yield. What does that mean? Let me go back to the puts only. The percentage naked yield is referring to the return you would make on the position if, in fact, it expired worthless based on the full cash secured amount that you'd put up for the position. Notice that the percent naked yield and time value for that 345 put we were discussing here, 1.7% midpoint time value, 1.8% naked yield, is essentially the same as going down here to the 315 because of the monetary value that we'd have to put up for each position. Although the premium is much higher, I'm putting up 30 points more to do a cash secured put here at 345 than I would be at 315. But when you look at the time value, you look at the naked yield, you always see the highest for a cash secured put, naked put, or for an at the money call if you're just selling a call. You always see the highest time value and naked yield right at the money. As you go deeper out of the money for puts, lower strike prices, or in the money for puts, the higher strike prices, you see a lower time value, and in this case, a lower naked yield. That's related to what's called the at the money bell curve, where on any given stock at any given time, the highest time value premium will always be right at the money, where the stock is currently trading. The 330 strike here has the highest time value at 3.5%. As we go below that, the time value percentage of the premium lowers. As we go above that and deeper in the money, our premiums are increasing, but the time value is decreasing as well. Now, this is only a 50% probability, of course, right at the money. So that's why we look a little bit lower for those higher probabilities we talked about, while still making a reasonable return if we wanted the position to expire worthless. Some investors who may want to get into the stock but get in at a lower price than it is right now may sell an in the money naked put. But remember, they're still only taking in 1% time premium or 1% yield because most of what they're taking in is the intrinsic value that they're going to have to pay that higher price for. It's not regularly used, Marcia, but it can be used in the money put selling if you really wanted to get into the stock and you saw a good enough price that gave you a good enough break even or cost basis if you did get assigned at those higher strikes. But again, my opinion is, and my common discussion with investors in power options over the years, most of them are in this 68 to 78% range, looking for a 1 to 2% yield on the position with the naked put, hoping it expires worthless. But hey, if it does fall and they get assigned, they don't mind having the lower cost and they plan to be in the position longer term. Big key there, of course, is that regardless of whether you're considering selling those in the money naked put positions versus the out of the money, remember, don't sell a naked put just for the premium. Don't sell a naked put just because it has a high implied volatility or it's in the news. only sell a naked put position if you would not mind owning the stock long term, because that is a potential outcome.